So we're going to talk about our newest concept. It's called the Buy Sell LLC. Now, how many of you, show of hands, have worked with LLCs, either personally yourself or with clients? A few of you? Okay, good. I only see a couple of videos, and those that I saw, they're raising their hand. That's good. So this will make it easy. So the whole idea of what we're trying to do here is have a tax strategy, if you will, that accomplishes a few different things. And we'll hit all those things very shortly. But obviously, buy sell planning, transitioning that business to co-shareholders, to family members. That's an important part of having a business. Secondly, this is the part that I really like the most. If you could repurpose those life insurance policies for things other than buy sell, let's say, you don't need them for death benefit purposes. Is there a good way to do that? So this is kind of what I like to call having your cake and eating it too. The buy sell LLC strategy lets you do both. Facilitate buy sell planning and also repurposes life insurance policies for who? For the business owner's own personal planning needs. Okay, this is how it's going to be a little bit different. You'll see more shortly. All right. So, fact, estimated 73% of privately held businesses plan to transition their business ownership over the next decade. This represents 14 trillion of wealth. However, 70% of business transitions fail or never go to market because many business owners have no succession plan in place. So I always like to say, we all know about what wills are. I consider buy-sells to be like a will for your business. So if you have a buy-sell agreement, that's like a will for your business. 2/3 of business owners don't have a will for their business. So something to keep in mind when we're talking about this. So our agenda today is we're going to talk about what I call the business strategy timeline. We're going to hit the buy sell LLC concept. We're going to talk about a new idea. I call it a Connelly audit. So we'll talk about what that all looks like in just a moment. So let's talk. Okay. Hello, unknown participant that's now joining. Welcome. Let's talk about where buy sells have been over the last 15, 20 years. I like to call this the business strategy timeline. So there's been cross purchase agreements. There's been entity purchase agreements around for decades now. And I don't know, am I allowed to ask questions and see if people know the answer? Can I give it a shot here? All right, I'm going to go ahead and do it. Let's have some fun. So when I say a cross purchase agreement, any brave soul, anybody want to describe high level? Don't worry, I won't ask you task questions. Anybody want to describe what a cross purchase agreement is? Anybody know?
Isn't that more than two people?
It could be. Yep, it could be. That's a good start. So typically you're going to have two or more business owners. That's why you do a cross purchase. Good. Anybody want to build on that?
I see Jimena unmuted. Yeah.
I'll keep, just jump in at any moment. Don't be shy. But we're talking about typically, so let's say Mike and I are business owners and we're 50-50 owners of, I don't know, Micah Acme Inc. I'm not being imaginative today.
We
all
make
right?
donuts.
So donuts. Okay. All right. I know it's on your mind today. 50-50 owners of Donuts Inc. You're worried that if I predecease you, that my 50% interest in Donuts Inc. is going to go to my spouse, Mary. You despise my spouse, Mary. You do not
She's
want
wonderful,
to be in
but she's a
business with her.
lousy cook. So would make a good donut partner.
And unfortunately, she actually knows you, and I am not going to tell her that. But we are 50-50 owners. So instead, let's do a buy-sell agreement. Remember, that's a will for the business. So we agree amongst ourselves, my friend Mike and I, that if one of us predeceases the other, the survivor will buy out the business interest from the deceased. That's where life insurance comes in place. We can each own a life insurance policy on one another. And if I pass away first, those proceeds will go to him, Micah, and he'll have the money to buy out the business interest from Mary. She gets the cash, he gets the business. If we want to get a little bit wonky here, there's what we call a basis step up. So his basis will be stepped up to the purchase price of the business. I love cross purchase agreements, especially if there's just two owners. They're simple and they're to the point. So those have been around for years along with entity agreements. I'll go through an example of all these coming up. Entity agreements are where you have the business as the owner, the beneficiary, and the premium payer. So everything's around the business. So instead of it just so it's Dane, right? So I see Dane and Micah and Andrew. Let's say there's three of us. We have let's say I own 34%, Micah's 33%, Dane 33%. We own Donuts Inc. We could have that business be the owner, beneficiary, premium payer. That's an entity agreement. Some people call them stock redemption agreements. That works out pretty well too. Proceeds pass away. Micah, I'm going to knock you off first in this example. You pass away. Let's say it's a $9 million business and we have $3 million on each of us. $3 million of the proceeds on Micah's life go to the business, Donuts Inc. And it's the business that effectuates that buyout, that buys out Micah's business interest from his spouse. And Dane, you and I, man, we're 50-50 owners at this point in time. It's all ours. Now, problem is with most entity arrangements, you're not going to get that income tax basis step up. So arguably that's a disadvantage. So, and that's kind of been the landscape for a number of years. I'm going to hit the buy sell in just a moment, but there was this huge event that came forth 2 years ago called the Connelly decision, Connelly versus U.S. That changed the landscape, but also opened up the door, if you will, to a concept that's been around for a while, the buy sell LLC, but it put that concept on steroids as far as it being a viable buy-sell concept to talk about with your clients. So I'm teasing you just a little bit here. We're gonna unwrap that in just a bit. Let's move forward here. So cross purchase. Remember, that's Micah and I. We could have life insurance on one another. The problem with cross purchase agreements, that's why we have the question mark. If you add a business owner, let's say you have 3 owners in cross purchase, is that just 3 policies or is it more than that? Does anybody know? Dun, 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 dun.
It's going to be more.
It's going to be more. Okay, so we're looking at 6 policies. Why? Because you each have to have a proportionate interest of a policy in one another. So you got 3 policies, you're looking, or excuse me, 3 owners, you're looking at 6 policies. So the disadvantage of a cross purchase agreement is you get 3 or more owners, you have a lot of policies. There's nothing illegal, there's nothing wrong, there's nothing unethical about it. It's just a pain in the butt.
There's nothing unethical.
Okay, I think I heard my little echo there. Okay, entity agreement. Remember we talked about that. That's where Dane and Mike and I owned the life insurance policy through the business. The business is the owner. This business is the beneficiary. The problem there is you're not always going to get that basis step up. We just talked about that.
Let me interrupt real quickly before you move
Yes.
on. What I've seen in my role as the regional here is most of the buy-sell agreements that are in place are entity purchase, and it's not because they were trying to minimize the number of policies, although that is a very real thing, because if you have 3 or more, it becomes cumbersome. It's because everything's run through the business. Let's just run this through the business. It's a lot easier for the business to pay for it and to own it and be in charge. And I think it's just more of an accounting ease than it is good financial planning. But that's where we are right now. So, I'm gonna not steal some thunder, but there's going to be an opportunity here for you to reach out to every business owner to do some sort of review and just tee it up that income tax basis step up may not be available. That's a compliant way of saying they don't get a step up. They just don't know it. They just ran it through their business because it was easy, but it doesn't make it a good financial plan
Yeah,
when
they
there's better
don't know
options.
what they don't know, right, Micah? And this is another way of saying what you just said. It's a lot easier just to write the company check, right? For all those premiums, regardless of how many owners there are. All right, good call out. Good call out. All right, so let's move on now. I'm going to show you a concept which has a few moving pieces. And we're working on the final graphic for this, but you guys kind of get a sneak peek, if you will. All right, so this is special just for today. But even pre-Connelly, this Supreme Court thing that I just keep talking about, an LLC, a limited liability company, that's been around for a number of years, and life insurance can be owned by an LLC. So, Mike and I were just talking about entity agreements. You could have an LLC be the owner, beneficiary, premium payer of life insurance. Now, if you got 2 owners, I'm just going to be frank with you. You could probably just own a policy on one another, kind of back to my other example, just cross purchase. This really comes into play if you're thinking about clients, if you have 3 or more owners. 3 or more owners, I want you to start thinking about not only, entity agreements, but LLCs. I'm going to explain to you the power of LLCs. I'm going to convince everybody here. LLCs are one of the most powerful tools you can use for this sort of planning. Okay, so this is a traditional buy-sell pre-Connelly LLC. You're going to have the LLC be the owner, beneficiary, premium payer. Okay, I haven't told you anything new yet. I don't think I have. All right.
And Andrew, this LLC isn't necessarily Donut Inc., right? This is a separate company?
This could be
Or is this
Donut
Donut
Inc.
Inc.?
This
Okay.
could be Donut Inc., or it could be a separate company entirely.
Thank you.
The key is you're trying to facilitate the life insurance proceeds through this LLC. Now, whether it's also Donut Inc. or a separate operating company, somewhat irrelevant to the conversation. But good question though.
Andrew,
Okay.
if it is a separate LLC other than Donut Inc., does that change the cost basis scenario if it's held outside and those proceeds are used by
Does
the
not, as
owners?
long as the business interest is exchanged through the operating company, it does not change the basis calculation at all. You would still get a basis step up. But I'm gonna hit that in just a second. You guys are actually ahead of me here. Smart group. That's pretty good. So business, the LLC is owner, beneficiary, premium payer. Somebody passes away. The proceeds, this is the key here. Listen up. Proceeds are going to go to the business, right? It's an entity agreement. It's no different. Those proceeds, because it's an LLC, this is crucial. All right, drum roll. Those proceeds are going to go through the LLC because it's what we call a conduit tax entity. It's a flow through. They're going to go through to the survivors. So, Micah, you're dead again. Sorry, my friend. So the proceeds go to the business. They flow through to Dane and I. We can buy out Micah's business interest in our individual capacity. So it kind of almost starts to talk and walk almost like a cross purchase agreement. So the money goes into the LLC, it flows through to Dane and I, then we can buy out Micah's business interest. And Dane, that's how we get the basis step up. Because at that point, it's kind of walking and talking like a cross purchase agreement. You see how that works? It flows through. We're the ones doing the buyout, not the LLC. Oh, I get this question sometimes. Does that mean the death proceeds are not are not taxable anymore? The death proceeds remain non-taxable regardless. They flow through the LLC in a non-taxable way. So they don't somehow become magically taxable. And we'll get our basis step up. So LLCs.
Andrew, I had a question. Yeah,
Yes.
it is Eddie Chan. So the
Hi, Eddie.
LLC,
Yeah.
hi, the LLC is the beneficiary,
Yes.
right? And
Yes.
then sorry, Micah, but when Micah passes, the LLC receives the proceeds.
Yes.
You're saying there's a flow through provision so that when the two survivors receive those the funds, there's no taxation there?
That's what I'm telling you. And the operating agreement, which all good LLCs have, should specify that. So you want to work with a good attorney that makes sure the operating agreement has those monies flow through to the survivors so they can do the buyout. Does that help, Eddie?
It does. It just seems like if it's going from an LLC to an individual, I mean, that's great because there's no taxation, but yeah, it's
Yeah,
great.
but you got to remember the LLC is the alter ego for tax purposes of the surviving owners. For tax purposes, they're one and the same. That's why it stays tax free.
Okay,
Yep.
thanks.
Yeah, you
Andrew,
betcha.
when you say good attorney, does that mean your advanced team and your team can help with that, or do we need to have our own great attorney?
Oh, well, I like to think we're very good attorneys on our team. We could certainly give you consultation. We could certainly give you specimen agreements on what the language should look like. But the actual operating agreement, you're going to have a real non-corporate attorney draw that up for you.
And the
And
attorney can consult with your team, correct?
Oh, thank you for bringing that up. Yes.
Exactly.
One of the
So bring the
few.
attorney, yes, and
Yeah,
have
we're one
the
of the few.
team.
Please.
Yeah, so bring the attorney and have the team consult with Andrew's team to, and they help them to do the attorney does the implementation, the team does the consultation. Exactly.
And we're one of the few companies that allow their advanced markets team not only to talk to those other centers of influence, like the attorneys and the CPAs, but as long as we have the advisor on the line, we like the RVP or the RSD to be there too. We could also talk to the clients. So if they want to be in that virtual room, we could all talk together. It's another value add. All right. Okay, so buy-sell LLC, owner, beneficiary, premium payer. This is just an entity agreement. What I like best about this concept, again, pre-Connelly, I'll get to Connelly, is the following. LLCs that are taxed like partnerships, and 99% of them are, you kind of elect to have it taxed like a partnership. You could transfer those policies out. So let's say Micah, well, I still want you to be dead, my example. Sorry, Micah. So, but Dane, let's say Dane is sick of dealing with Andrew. We want to unwind the LLC. There's a valuable life insurance policy, a permanent life insurance policy, because we're smart enough to use one on his life. Dane wants to get that policy back. Guess what? Using an LLC taxed like a partnership, most of the time you could get that transfer right back out to Dane tax-free. So he can get a valuable asset at the end of the day and dip into that now personally owned life insurance policy for his own personal retirement planning needs. If he wants to transfer it to an ILET, get the 3-year look back rule, but let's talk about that at another time. But he could use that policy for his own personal reasons. So that's about what I meant about having your cake and eating it too. Most buy-sell arrangements, most entity arrangements, if you transfer that policy back out, even to an owner slash insured, that's a taxable event. Not with LLCs that are taxed like partnerships. That's the reason LLCs are so powerful. Not only will they give you that basis step up, right? We just talked about that with Eddie's good question and Dane's as well. But you could do double duty with those policies and get them back. So you're talking to a client and you're saying, you know what? If we structure this correctly, we could leverage this for both business succession purposes. And if you don't need it for that, for personal planning purposes, they're going to say, tell me more. I want to hear more about that. That's an attention getter.
Andrew, if the policy stayed in Donut Company, then when that changes to the owners when they go to retire, that ownership change could be a taxable event. However, if we separate it out into this separate LLC taxes and partnership, it's already taxed going from Donut to this other LLC partnership, and therefore that ownership change is not a taxable event.
You're close, but not you're close. What makes it non-taxable event is that there's a little provision in the Internal Revenue Code. I promised myself not to throw it out there today, but I'm going to. I can't help myself. It's called 731A. 731A, all right? What that allows you to do is to take property from an LLC and transfer it back to the owner as a return of basis. Remember, you're making contributions to this LLC, whether it's a separate operating arrangement or not, and getting basis at the same time. You get credit for that when you transfer that piece of property back out to one of the owners. You just happen to be an
dollars
owner
were already
insured
taxed
here.
at the Donut Company, right?
You got it.
Yeah. Okay.
Now you got it. Perfect.
And just to make Andrew's point, in real life, there's a trucking company that one of our advisors is working on, and there's an owner, and the owner is 60 years old. The co-owners are his daughter and his CEO. And he's going to retire in the next 10 or so years, but they are going to continue the business afterwards. And one of the big questions was, how, if we have this policy on his life and he retires, how does that all work? And Andrew's concept here that he was just talking about was the perfect solution for that kind of scenario where they could then transfer it once again. So you don't have to die or decide that he doesn't like Dane. Someone can retire as well. And it allows for financial planning beyond that versus a traditional just buy sell might not have addressed that.
Yeah, I love that, Mike. And it's like, how many times have we all heard, oh, fine, I need a buy sell. Let's just do a term policy and just call it good. This invites a further engagement with clients to think a little bit more holistically, not only about their business, but their own personal retirement plans. Okay, so I'm going to move. Any other questions on that? Don't worry, I'm going to return to the LLC because I like it. I'm just going to take a brief little detour into Connelly, and then we'll come right back. Okay, so rarely is there an advanced market case that goes to the Supreme Court of the U.S. I mean, people that do what I do are just giddy about this to this day. We're tickled pink. All right, so we actually had one of our own go to the Supreme Court. And I see some of you smirking out there. Yeah, it's kind of nerdy, but that's okay. So this went to the Supreme Court. And I'm going to brief this up really quickly because I don't want to get too much into the weeds. I'm trying to help you and help myself. There were two brothers, the Connelly brothers, that put together an entity buy sell a number of years ago. And the whole idea is they wanted to fund that with life insurance. Okay, so far, so good. Within the buy-sell agreement, remember the will for the business, they had a provision in there to revalue the business annually. I think the idea initially was to go ahead and adjust the amount of life insurance to reflect the actual value of the business. Part of the problem with Connelly is they never revisited the business valuation provision. It was kind of loose, and they just kind of let it go. Well, one of the brothers passed away, and so the proceeds were paid into the business. Now, up until this point, most practitioners looked at entity arrangements like this, at least ones that were funded with life insurance. You have one of the brothers in this case with the proceeds going in. If he passes away, the proceeds would go into the business. The business would turn around and use those monies to effectuate a buyout of his deceased shares. And the life insurance would be considered to be transitory. It would come in and go right back out again to effectuate the business interest. That's how the profession looked at entity arrangements for decades and decades. Supreme Court in this decision, unanimous, okay, did something completely different. But they said, you know what? These proceeds are an asset of the business, even if temporary. So in this case, we got 50-50 owners of a business. We're going to include at least half those proceeds in the estate of the deceased. I'm going to stop there. That should get your attention, because that could become not only an estate tax issue. If you're counting those proceeds in the taxable estate, that could be an estate tax issue. But secondarily, that's considered to inflate the value of their business for buy-sell purposes. So it also becomes a buy-sell problem as well.
Wouldn't
This
the way
decision
around that, Andrew, be if the client owned that business or part of it in an irrevocable trust outside of their estate, it would only inflate it outside of their estate, right? Had they done it that way?
Yep, that's one workaround, is having it owned in an ILIT and irrevocable life insurance trust. Dane, another workaround is to have maybe a trust deed arrangement, or just do a cross purchase agreement where it's not in the business to begin with. Right? Those are all potential workarounds. They all have challenges. Some people don't necessarily want to use an ILIT for that. Some people don't necessarily, especially if you have 3 or more owners, they don't want to do a cross purchase agreement. We're going to get to the solution, which is going to bring us probably full circle back to the LLC in just a moment. But an ILIT can be a solution for that, because it does keep the proceeds out. Before I move on, because I'm going to get back to my good friend, the LLC, any questions on kind of what happened in Connelly? So the proceeds are adding to the estate. Now they're not just coming in and going back out again. Okay.
So before you move on, I just had a thought. One is the Connelly brothers and their business, buying an entity, purchase, buy, sell. Those things are everywhere.
Absolutely.
They're out there. Everybody in their book of business, if you have a business owners, I bet that stuff, one, having a buy sell is better than not having a buy sell. That creates a lot more problems. But the buy sells that are in place are probably a lot like Andrew's example. And the second part, and Andrew, correct me if I'm wrong. So with this new Connelly decision, in our donut scenario, if we have 3 owners and $3 million a piece, if we buy $9 million worth of life insurance, that inflates the value of the business by $9 million. So we need more insurance. But if we need more insurance, then it inflates the value of the business. So we need more insurance.
It's a circular formula.
That's an unsolvable. Yeah.
That's why I meant about it. Not only affects it from a tax perspective. Let's face it, the exemption amount for estate tax purposes, $15 million a piece, and because it was a big case, it did create an estate tax issue. There was like almost $1 million of extra tax that the estate had to pay. But in reality, it's more of a buy-sell sort of an issue than anything else. This affects everybody, not just those that have large estates, if that's part of what you're saying. Yeah. Okay. So is there a solution to this? I would say that there is. And let's go back to the LLC. All right. I'm not going to repeat what that was. The buy-sell LLC, all the advantages of that. One policy per insured. You can get those policies back out. It's a great argument for permanent cash value life insurance. Can I brag a little bit, Micah, just on a little something? Is that acceptable, Marianne? Just a
Absolutely.
little bit. Okay.
No, I love this. Yeah, go ahead.
Andrew,
Well,
quick question. See, you
yeah.
say LLC. You said it had to be. I heard you mention LLC taxed as a partnership. It won't work for an LLC taxed as a S corp.
Correct. That's correct. Most LLCs, about 99% of them are taxed as partnerships. You can elect to have them taxed as an S corporation if you want. This, what I'm talking about, will not work if you elect to have it taxed as an S corporation. Good? Okay. All right. So partnerships. This is the bragging part. So we're the only carrier I'm aware of that actually consulted with an outside law firm. We have our own legal department. We're lawyers. We have a separate legal department. So we bounced this idea off of them. Post Connelly, will an LLC tax like a partnership? Potentially, if the operating agreement is drafted correctly, can that get around the problems of Connelly? Can that get around the problem of estate inclusion? Can that get around the problem of having those proceeds in effect disbalance that buy-sell agreement? And so we consulted with an outside law firm, and I bounced off of this idea off of them. If the operating agreement, follow me here, if you could allocate those, both the premiums that you paid, but more importantly, the proceeds to just the survivors. So back to Micah passing away. Sorry, you're back alive again. Now I'm killing you off again, Micah. I don't know why we're picking on Micah, but we are. Proceeds will go into the LLC, and this is key. Not all entity agreements have this. So all those entity agreements that Micah just talked about, because there's tons of them out there, you're going to have to, what I call, audit them. You're going to have to look at them again. But you could have a provision in there that modifies those agreements. And what that provision is, once proceeds come into the business, let's say there's a death, Micah passes away, you could allocate those proceeds to just the survivors, and not to the deceased. In this case, Micah's estate. That will get you around the negative ramifications of Connelly. So it's just allocating those proceeds just to the survivors. You could do that in the operating agreement. The problem is most entity agreements these days that you look at make no mention of that. And a lot of those entity agreements, a good portion of them are pre-Connelly entity agreements, and they have no provision allocating any kind of proceeds if somebody passes away. They weren't even thinking about Connelly at the time. Those agreements need to be looked at. They need to be examined. My team can do that. We have a buy-sell review service that can help you with that. So after we got this outside law firm to look at it the same way that we're looking at it, we decided to go ahead and replace the Farmers and Ranchers Initiative, which we were originally going to throw out there, with the buy-sell LLC concept, because we thought it'd be just a little bit more pertinent where we're going right now. So we're calling this what I call a Connelly audit. So what does that mean? What we want you to do is see whether or not you have a buy-sell agreement out there. Do you have a business owner client? We have something called the 5 core questions. If business transition planning is big for them, and we can send you all these forms, Mike and myself have them all, then you go on to step 2. And we have a buy-sell checklist. Do they have a buy-sell agreement? Remember that will for the business. If so, how's it structured? Is it a cross purchase? Is it an entity purchase? How old is it? We need to ask these questions to see whether or not the buy-sell agreement needs to be looked at. Number 3, we have a buy-sell agreement review. We will look at those buy-sells. So we have a team that will do that. Will in fact provide an audit on it. It's like you bring your car to the dealership and they'll always find probably something wrong. There's almost always something in every buy-sell agreement. A lot of times the business valuation provisions are old, antiquated, or the business itself hasn't been valued recently. So we will look at the buy-sell agreement to see whether there's a Connelly problem, and if it's feasible, you could work with an outside firm that we work with called Marshall and Stevens, and we can get you a complimentary business valuation as well, just as a plus of working with Midland National. I think that's a pretty good deal. I could talk about Marshall and Stevens at any point if we need some more discussion on that. And finally, what you're going to get back from my team is that audit, the result of the audit, the result of the review, along with recommendations of what to do with that buy-sell agreement going forward. I guess the call to action more than anything else, and Mike and I, you and I both hit on it the last, 40 minutes or so, is find the business owner clients that are out there. See if they have an entity agreement. I'll bet the lion's share of them that do haven't even thought about Connelly, and they need to have those agreements looked at. That's where you pull in our team to help you with that whole endeavor.
Andrew, could I ask a clarifying question?
Please.
On the essentially post Connelly, so again, 3 owners. Micah, this is in the separate LLC, not the donut company.
Yep.
Cross purchase LLC. Micah passes, that money comes into that LLC. It does not go to his spouse. It goes directly to you and I. And then from there, we take that money and then directly buy the shares from his spouse, and therefore it circumvents. Is that really kind of it, as opposed to going directly to Micah's spouse and increasing the estate? Is that how it's done?
Yeah, that's exactly it. Because the only people that have the money at this point in time, the proceeds are us. So the old pre-Connelly with an entity agreement, I mean, those proceeds would go directly to all the owners, the survivors, but also the deceased owner's estate. In this particular case, the money's just going right to Dana and I. We're effectuating the buyout ourselves. Never even
And we
goes,
just need to
goes
make
into us.
a change to the operating agreement, essentially.
Yeah, but I don't want to minimize that. It's a big change because a lot of them don't have that provision. But yeah, at upcoming meeting that we have in Chicago, am I allowed to talk about this, Micah, about our big meeting coming up?
Please.
So we have an advanced market symposium in Chicago. So I think for the Midland folks, we're looking at the 22nd and the 23rd. And so a member of that outside law firm, her name's Kathleen Bilderbach. She's a national presenter on all things tax planning. We're actually going to have her as our primary guest speaker. So she's going to talk about not only this concept, but also a lot of other buy-sell planning for high net worth clients. So again, I'm just advertising for that meeting coming up. Micah, I think we're going to get those invitations out within the next day or two.
One follow-up question, Andrew. What is the clause or something that requires you and me to now buy the shares? That's definitely a question I've gotten from people. Well, okay, that's great. Now all of a sudden my spouse might be out of it. What do we? That's fair to just keep a clause that says, now, Andrew, you and I are required then to take that money after we've received it and then buy out Micah's spouse?
That's a good question, Dane. That's what the separate buy-sell agreement is. You got the operating agreement, but the buy-sell agreement legally obligates us to do that buyout.
There we go. Okay, perfect. Thanks.
Yeah, two agreements, if I didn't make that clear. Good question. Okay, so let's bring this home here. Summation is really what we're talking about. We talked about the timeline of where buy-sell agreements were. We talked about Connelly, right? We talked about the enhanced buy-sell LLC. and how maybe a Connelly audit might be a timely thing for a lot of our business owner clients to do, leaning in with Micah's team, what we could do here at Midland National. So the goal here today was to throw, some technicalities out there, bring your attention to the Connelly decision, but also provide a strategy that gave you an idea as an out, if you will, to help mitigate some of those issues. All right.
I think
Any questions at the end here? Yes.
one of the things we're working on is we're going to have like a file where Miriam, we can put all these things you said, Andrew, step 1, 2, 3, 4, in a shared file for all of Perennial. We're working on that so that everybody can go grab those easily if they need something like that. So
Love it. It's an efficient way to go ahead and kind of categorize things a little bit. Maybe I could learn something from it as well. I'm big into talking about strategies and ideas. Putting them into folders is a little bit difficult for me sometimes.
So let me bring some sales perspective to this, because we all exist to help clients. That's why Perennial's here. That's why we're here. Like, we don't exist without you guys helping clients with this stuff. Let me tell you that most RIA firms in our area, other than Perennial, aren't even asking the question, like, do you have a buy-sell agreement and when's the last time it was reviewed? But those are two very easy questions. You guys are leveraging us as your back office for this kind of stuff. And frankly, we exactly want that. There's a huge value as Perennial reps that you have that the advisor RIA around the corner doesn't have. And so it's a huge value to your client, because chances are, if they have a business and they don't have a buy-sell, well, that's obvious. This helps make sure that business continuation happens the way they want it. If they do have a buy-sell, they might, like Andrew said, we don't know. They don't know that they're sitting on a situation that isn't going to work like they thought it was going to work. And it might be a tax bomb, but it's avoidable with what Andrew was talking about and making these adjustments. So it's a huge value to them, not only to your client, but like the people that are writing these agreements, the CPAs that are consulting on these, the attorneys that write this up. Like, I want every one of you to be in connection with, someone asked the question, well, does your team do this or does a local? And the answer is yes, because we work with them to make sure it gets done right. But for you guys as advisors, to be known as the advisor that can handle this stuff when no other advisor can, you're going to get more business owners coming to you from the attorneys that write these types of agreements, because they know that you have the resources to handle this. There's not many attorneys that get in a room with Andrew or Paulina or the rest of the team and then come away thinking that, oh, wow, that was terrible. They're like, oh my gosh, this is a huge resource. I have other business owner clients that aren't working with Perennial. Maybe they should be. So from a marketing standpoint, I want you to ask the question, like, do you have a buy-sell agreement? When was the last time it was reviewed? It's a huge value add for you guys. So Miriam and Dane, thank you for asking Andrew to come on and share, because this changed everything. Everyone with a buy-sell agreement that's an entity purchase absolutely needs to have it reviewed. And even if it's a cross purchase, if it hadn't been reviewed recently, it's a great resource. Did I miss anything on the sales side, guys?
I think that was great.
That's why you need Micah
Awesome.
and I, man. I could be the technician all day long, but Micah makes it real.
Awesome.
I have a couple
Thank you,
of
guys.
follow-up questions, just so I'm clear on this. It's Eddie again.
Hey, Eddie. Yeah.
So prior to Connelly, everything that flowed through would have been taxable? Is that what I'm understanding?
No, prior to Connelly, if you had an entity arrangement, you just would not have included any of the proceeds in the deceased estate, and it would not affect the value of the buy-sell. Money would be coming in, then going right back out. That's what I meant about the T word, transitory. It would have no economic effect on the buy-sell. Post-Connelly, it did. That was the big transition. It
increases the value, right, of the.
It increases the value of the business and the owner.
Yeah,
yes.
yeah. Okay. So that's what the main difference was. On the example that you were giving, Micah's family. Goodbye, unknown participant. So with Micah's beneficiaries, when the two of you then pay out, Micah's beneficiaries still get the step up, right, in basis as they're getting paid out? from a tax perspective?
Yeah, they don't have to worry about the basis. We're getting the basis. The surviving owners, our basis is going to be equal to the purchase price. So we don't inherit Micah's business or basis from his family. It's
Okay,
equal to the purchase price. So we're getting that basis step. That's where you want it. They're just
Right.
getting tax-free proceeds.
the proceeds coming, okay, yeah, that, I just wanted to be clear on that. Okay, thanks.
Yep. You bet. Great questions.